number of speakers. So I think let's formally start. So let me welcome you all to the EGROW webinar series, which we have started in 2020. And we have covered nearly 180 webinars under this webinar series.
Wonderful.
We have made an attempt in this webinar series to bring a blend of foreign scholars and domestic scholars. And we have been very successful. We have also had the privilege to host under Task Force 5, under G20, 11 of these webinars, again, wherein we've gotten a blend of foreign speakers, academicians, scholars, public policy makers, as well as match them with the Indian side. Today, we are on a very important topic, which is obviously in the minds of almost everybody in policy making as to what happened with the aggressive interest rate hike that the Fed Reserve followed. So we requested Professor Subrahmanyam from UCLA Anderson School to come and enlighten us. He's sitting there. He knows the Indian system. He knows sitting there. He knows the American Fed system. So we thought it would be best if he come and tell us about what is happening there. And then we also invited Mr. Dadoo, who's a civil servant who has worked in similar areas, to chair such an important topic. We obviously had to go to Mr. V.K. Sharma, who has been for long years in the Reserve Bank, and in the Reserve Bank has been considered as an authority on duration. As a discussant, again, we went back to the RBI and invited Mr. Anil Sharma. That's the panel for today. Let me introduce the chairman of the session, Dr. V.K. Sharma, and then I'll hand over the session to him to conduct the proceedings further. Mr. V.K. Sharma is former executive director of the Reserve Bank of India and a former member of the Markets Committee of the Bank for International Settlements. He is currently on board of governors of International Management Institute, Delhi, and academic advisory board of MIT World Peace University's School of Economics. He is also an independent director on the board of Equitas Small Finance Bank Limited. He has had an illustrious career in the field of central banking, where I think apart from the administrative skills that he has also been very, very scholarly. He was ED responsible for 11 critical and sensitive departments. The most important, which I think, was when he was the chief dealer in the External Affairs Department. And right on the job, he had to take decisions because as a chief dealer, they're controlling millions of rupees. During his tenure at the RBI, at that senior level, obviously, he has served as chairman, member, director of several important committees, working groups, governing boards, councils, bank boards, and represented RBI in various prestigious national and international events. After retirement, he was appointed by the Government of India as chairman of the working group on common.
Mr. Charan Singh, we lost you.
Hello.
I can see you.
Yeah.
Charan,
Can you hear me?
Yeah.
I think there's a problem.
So he has a versatile performance track record with a strong action, outcome, result, and delivery orientation in policy making and execution. He has formidable credentials in financial and derivative analytics and risk diagnostics and risk management solutions. He has published extensively in prestigious journals like London Central Banking and Bank for International Settlement. He has worked on one paper which is very important, that is the derivative, which was covered by the Economist of London in its issue dated 16th February 2013. Besides, his paper, The Challenge of Financial Leverage in Modern Banking, was also published in April-June 2015 issue of Vikalpa of Ahmedabad. He has been a guest speaker at various institutions, including IIMs. He completed, and I think that is what holds him in very high esteem, MSc in Physics and BSc in Physics, pure and applied mathematics. And I think that is what he brings throughout his career, the meticulousness and preciseness that he was trained in. He also holds an advanced studies certificate in international economic policy research from Kiel Institute of World Economics, Germany. From RBI, he was the first recipient of the prestigious Lord Ellington Banking Scholarship Award. With this, I hand over the session to Mr. V.K. Sharma to take the proceedings further.
Thank you, Charan, so much for your very kind words about me and for inviting me to chair today's webinar session. We are very pleased to have with us today speakers and discussant with very strong and formidable professional credentials. So I think I'll first introduce Professor Avanidhar and give him some of his, very strong professional credentials. Professor Subrahmanyam is a highly distinguished scholar in finance, currently holding the Goldine and Irvin Harsh Chair in the Money and Banking at UCLA, University of California, Los Angeles. He received his PhD in finance from Anderson School 1990 and has since become a renowned expert in the field and research interests that include relationship between firms' trading environment and its cost of capital. And he also has authored or co-authored over 100 journal articles on these and other subjects, published in top finance and economic journals. Professor Subrahmanyam is also a member of the Working Research Group on Market Microstructure at the National Bureau of Economic Research in Cambridge. He is a highly acclaimed finance scholar and professor known for his prolific research and numerous accolades. Very significantly, he is among the most cited scholars in this field, with over 37,000 published papers citing his work. He has received numerous awards for his research, including Best Paper Awards at prestigious finance conferences. And he has also given keynote speeches on behavioral finance and financial liquidity at numerous locations worldwide. I can go on and on with, but I thought I would confine myself to very salient, credentials. Now, I welcome Mr. J.K. Dadoo. Mr. Dadoo, he is the former civil servant who has held important positions in the Indian government and 5 union territories over the past few decades. He has held several positions as namely Additional Secretary and Financial Advisor in the Ministry of Commerce and Textiles. Prior to this role, he was served as Joint Secretary in the Department of Commerce within the Ministry of Commerce, where he was responsible for overseeing trade promotion initiatives in Australia, New Zealand, Fiji, and Papua New Guinea. He also oversaw the National Center for Trade Information, the Indian Institute of Foreign Trade, and various export promotion councils, including the Council for Labour Exports, the Telecom Equipment Services EPC Export Promotion Council, and the Sports Goods Export Promotion Council. Additionally, he served as Director General of Trade Remedies, where he dealt with anti-dumping and subsidies and worked with the Board of Safeguards. He was also on the board of 7 public sector undertakings of 2 leading education and also on 2 leading education institutions of Government of India as financial advisor. And he also served as administrator of the Lakshadweep Islands, equivalent to the head of the state from 2009 to 2011. And I think I can go on and on again. Very formidable credentials of Mr. Dadoo also. So now I'll, with this, and there's one thing I must say, he holds a master's degree, MBA in marketing from the Indian Institute of Management, Ahmedabad. He also has a Bachelor of Law degree from university, and he topped Delhi University, uh, topped Delhi University in his economics examination from St. Stephen's College. He's alumnus of St. Stephen's College. So with this, I now go on to the credentials of Mr. Anil Sharma, who was my colleague in the Reserve Bank of India. Anil Kumar Sharma was the Executive Director of the Reserve Bank of India. Before taking over as Executive Director, he was heading the Enforcement Department of Reserve Bank of India as Chief General Manager. He has done his Masters in Economics from Doaba College, Jalandhar, Punjab, and was UGC Fellow at the prestigious and renowned Gokhale Institute of Politics and Economics, Pune, before joining Reserve Bank in 1986. He holds a diploma in Treasury and Risk Management and is a certified associate of Indian Institute of Bankers. Here there is a problem here. It was originally certificated associate of Indian Institute of Bankers. I still stand by that. But I don't know, later generation is changed it to certified associate of Indian Institute of Bankers. Just for your information. His experience in the Reserve Bank lies in the area of management, currency and banking, regular credit and supervision. He also worked as a member of the faculty in the Reserve Bank of India's College of Agriculture and Banking in Pune. With this, I conclude my introduction of the speakers and discussant, and I would request Professor Avanidhar Subrahmanyam to kindly make his presentation. And I must say that the time slot for both the speakers is about 20 to 25 minutes. And for discussion is about 15 minutes. I mean, we can always, exceed that, that's not a problem. But I think this is what the time slots will, keep us to the time that we have. Thank you so much. Professor Subrahmanyam.
Okay, thank you, Mr. Sharma, for that kind introduction. And it's my good fortune to be with such a distinguished panel and people who are actually in the policy arena. So what I'd like to do is to make it a really simple presentation. I don't have too many slides or data, but I want to look at the whole thing from a conceptual standpoint and see what we can learn from this. Because what happened is so basic and so shocking, at least as far as the recent failures in the US are concerned, that really we can learn from simply understanding and appreciating it at a very conceptual level. So let me share my slides. Okay, can the participants see the slides, Charan?
Yeah.
Yeah.
So it may be that you can't see me, but the system limitations may prohibit that. But of course, after the presentation, I will be right back, and seeing the speaker may just be distracting. Okay, so this topic for my talk is duration mismatch and bank systemic risk. And we already have people who know what duration is, but what I would like to propose here is that when the banking system lacks sophistication to this extent and fails the economy in such a drastic way, then we better get down to basics and try and understand what happened. So the basic talk is going to be focused on what's the optimal financial regulation policy for economic growth, and what, in my view, are some key elements that seem to have failed in the US at the present moment in time. So I'm going to explain this topic using the Silicon Valley Bank incident, and as well as I'll allude to the global financial crisis of 2008 as I'm talking about this. So let's take SVB first. And so, obviously banks have to worry about non-performing loans and default and all that stuff. But a very basic measure of risk is basically something called interest rate risk, which is managed using a quantity called duration, which we already had a mention for. But to understand duration, let's think about it in very intuitive terms so that we understand, like, basic undergraduate economics failed in the United States. So interest rate risk is simply the notion that when interest rates change unexpectedly, the value of an asset changes unexpectedly. And therefore, since interest rates have unexpected components to them, it's a source of risk, right? Now, interest rate risk is managed using a quantity called duration. And just to give you an intuitive feel for what duration is, some of you may already know, but I'll just explain in very basic terms. Duration is simply a center of gravity, right? So this particular money bag scheme is that, let's say a debenture or a bond pays you interest payments and then finally pays you back a principal. So this is the typical path that a debenture or a bond takes. And so the last wag is big because of the principal payment and the last interest payment. And so the duration, roughly speaking, is simply the center of gravity of that. So it's not going to be midpoint, it's going to be to the right, right? So it balances out the payment bags. The only difference is that it's like the money bags are calculated in present value terms, like today's dollars, because the dollars happen in the future, you have to bring them back to the present. Now, it's interesting that duration can also be defined as the percentage change in price over the percentage change in one plus the bond yield, which simply means that if the bond yield changes, 1 plus the bond yield changes by X percent, what is the percentage change in price? So that sensitivity is also called duration. They're both the same thing. The center of gravity concept as well as this are basically the same thing. I'll explain to you why in just a bit. But one more thing, the duration of a portfolio is approximately weighted average of the individual components. So you mix up durations 3 and 5, 50-50, the combination will have duration of 4. And if the weights are not 50-50, you just weight the average. Okay, so now the question that arises is there's this center of gravity notion, and then there is this percentage notion. So what is the link and why are they the same? The reason they're the same is that if you write down the price of the bond as simply the present value of its future cash flows, and you don't really need to know much calculus for this, I'm just explaining it in very simple terms. If you simply write down the price of the bond like that, then you can just differentiate it using simple calculus and get the formula in the bottom, okay? So if you get the formula in the bottom, right, remember, the left part of this formula, the second one, is simply the percentage change concept, and the right part is this summation concept. But the summation concept, which I've written down again here, right, is essentially the center of gravity, because this can be written as the weighted average of the time at which the payments occur, the second equality here, where the weights are simply the proportion of the present value contributed by each cash flow, summed over all the cash flows, okay? So you can see, roughly speaking, that the center of gravity concept and the percentage change concept are essentially the same using calculus, okay? So this is the formula here that you see. So now you don't have to understand anything here except just the notion that duration is simply if the discount rate on the bond changes by X percent, by how much does the price change? And since the discount rate on the bond depends on interest rates, duration is a measure of interest rate risk, okay? Okay, so long maturity debentures and bonds have high durations. Their CG is to the right, okay? And that's because long maturity instruments are more sensitive to interest rate risk, right? Simple. So like 10-year bonds will have more durations. Their CG or center of gravity will be to the right, okay? Now, so you know, maybe some of you know intuitively, I've just explained it using the derivation, but basically it's a very simple common sense thing that to be immune to interest rate risk, the asset side duration must match the duration of liabilities. Otherwise, you're exposed to risk, right? So if interest rates move and the duration of the asset liability is not set to be the same, then the mismatch will create a risk, right? For example, interest rates might change your liabilities by a lot. And if the asset doesn't move in lockstep, then you'll be exposed to too much liability, too little asset, right? Now, interestingly, this concept is taught in every basic finance class. Any MBA class you take, they will teach you this. Ye hai concept, you must match. That's the responsible risk management. And many of you know this. So sensible banks understand duration. Sensible banks monitor interest rate exposure. And you have to manage the durations, okay? And yet we have the SVB failure. So what happened in the SVB failure is a textbook case of mismanagement. Okay, so like this. And what is the textbook case? The textbook case is that you're matching deposits, simple consumer deposits, right, which 10 to 20-year government bonds and long-term loans. Right? SVB was bonds, and First Republic was 20-year, 10-year loans. So you tell me, this type of basic mistake where you don't match duration, right, leads to collapse. And we are left wondering, what kind of education are we giving students? What kind of message are we giving regulators when they don't care about duration mismatches? The banks don't care about duration mismatches. And what happens is Powell, Federal Reserve raises rates to combat inflation, and we have a mismatch. So depositors want to withdraw, but the bond values on the right-hand side, left-hand side are so low that you cannot meet the depositor claims. The assets have fallen too much. Right? Now, maybe these banks thought interest rates won't rise, but to argue that we are betting that interest rates will remain at 1% and 2% forever is a silly bet, because this cannot go on forever. 0% is a floor. The floor cannot continue. At some point, it has to rise. And of course, it rose faster than we expected because of the inflation created by various types of pressures, including the pandemic. But the point I'm trying to make is that this is a supposedly advanced economy. The carelessness with which they approached this duration matching was staggering. Now, then what do you do? If the banks are irresponsible like this, they don't match durations, you do a bailout. So Janet Yellen had lost no time. Like within 1 week, one more bailout, like the earlier Goldman Sachs bailout. Now we have SVB bailout. Say all depositors are covered, no problem. Deposit insurance covers up to 250K deposits, right? Oh, we'll cover all. Don't worry about it. 1 million, 2 million, 10 million, whatever deposit you have, we cover. Okay? No accountability, we'll cover everything. Where did the money come from? So essentially, the money came from the following. There is federal deposit insurance of 250,000 per account. Okay? So that's insured. And so all banks, including the large banks and small banks, contribute to a deposit insurance fund. So what Janet Yellen said was that consumers won't suffer, taxpayers won't suffer. The deposit insurance fund will make depositors good. So, but ultimately, of course, what it means is the moral hazard. Healthy, sensible banks subsidize SVB. Of course, money is not free. So if these banks are contributing and that money is being used, then the fund runs short. So they say, oh, Wells Fargo, come and contribute more. So ultimately, Wells Fargo keeps contributing, and then consumers of these healthy banks like Wells Fargo suffer. Okay, so this is the situation surrounding SVB. Basically, that's all. That's essentially what happened. So आप ये बताइए कि इतना simple, just such a simple thing, is being managed so irresponsibly. And so then the question is, why was this allowed to happen? Inadequate governance. The duration matching was not required. Banks know what they're doing. Let them do whatever they're doing. And of course, if things go wrong, there's always bailout. We help the banking sector. That's what we're here to do, to help the banking sector. Well, if your strategy is you're going to help the banking sector, ultimately taxpayers will suffer, because the banks will say, fine, the government will help us, we don't care. Now, maybe I'm oversimplifying it, but basically that's what it is. And so SVB had some other political connections. They contributed to Democratic Party causes very heavily, and the Democratic Party is in power. They used to contribute to what we call the woke causes, like climate change, diversity, and those types of things. And they're very sympathetic to the government, and the government was very sympathetic to them. So essentially, it's like no questions asked situation. And then that's essentially what happened. Okay, so that's one thing. The other thing I wanted to point out about the US system is to do with revolving doors for regulators, which is my passion, that I think that it's very important that I address here. And this is my second point, and then I'll turn it over to the other speakers. So this point also, I think, is very important to mention. Maybe it's just common sense, but the system in the US is very different from the system that I left the shores of this country for. And then I'm wondering, like, okay, so this seems like a bizarre system, the US system, given we take these things in India so seriously. And so let me tell you what our concern is. So आप ये बताइए कि जो Nobel laureate Ben Bernanke साहब है and former federal chair, वो आजकल क्या कर रहे हैं? So essentially, he's an advisor of a PIMCO, a fixed income giant in the private sector, um, multi-billion dollars, and we'll talk about it in just one more minute. And so he's working in the private sector now. He's working in the private sector not as a joke. At least $1 million salary, if I'm not mistaken, maybe more. And he's in more than one situation in the private sector. And the reverse is also common. Anil Kashkari of Minneapolis Fed came from Goldman Sachs directly. Okay. Now, these types of things are not minor conflicts of interest, like somebody gets on the board of Britannia Industries as a board of director. That's a minor COI. But this is a major COI because the money changing hands is quite large in these cases. And if Neil Kashkari comes from Goldman Sachs, likely he'll get absorbed back in Goldman Sachs when his federal career is over. So he was, for example, just to give you some press quotes, Ben Bernanke has officially entered the revolving door. He was hired as senior advisor to Citadel, a $25 billion hedge fund, $1.6 trillion global behemoth, PIMCO, and so on and so forth. Then they have some meaningless press statements about COI, the offers that are not regulated by the Fed, and so on and so forth. But these things don't seem very credible. So this type of situation arises. What is the potential cost? The potential cost of these things is like, no matter how much you say about, oh, these are not real COIs, conflicts of interest. The fact of the matter, boss, is that my point is that it can affect policy chances. So if your income post-regulatory life depends on the largest of those you regulate, how can you be unaffected by COI? It is not possible, because what you will get is at least 10 to 15 times more than what you're making. So it's very simple common sense. It's very difficult to get a person to understand something when their salary depends on their not understanding it, right? So if you're going to go back to that sector, are you going to really take actions that are not in the interest of that sector? Now, that sector is not the only sector in the economy. You also have to worry about consumers and other people who kind of are within the financial ecosystem. But what you're really going to be worried about are the people in the world that you essentially draw your financial security from post your regulatory life. And again, I'm not complaining about being on a BOD of a corporation or private sector or something like that. I'm talking about real, positions in these sectors that demand very hefty salaries. And so that's the issue that I want to raise. So now let's see that distortion that's actually was caused by this type of revolving door in the GFC. So to understand the distortion, let me take 1 minute to just come back to basic brass tacks and just talk about what is an interest rate policy for the Fed actually try to do. To be very simple for even an undergraduate class or something like that, basically they are trying to balance inflation and unemployment. So increasing the short rate, the federal funds rate, induces consumers to save more, spend less, and reduces inflation. So you can control the inflation via the short rate, the federal funds rate at which you kind of let banks borrow from you in the window, right? So that's one way to do it. You can also do QE. QE means you can buy long-term government bonds. So on the one hand, एक हाथ से आप issue करिए bond को, दूसरे हाथ से उसे खरीदिए. So if you do that, you can control the long rate because you control the supply of the bonds that the open market can purchase, right? So you can control the long rate as well. So short rate by simply setting it, and long rate by simply buying and selling government bonds, like your own bonds you buy. But I would suggest that we also have a responsibility to let the rates be as close to reasonable as possible and not just do whatever you want. For example, you can ask yourself, if inflation wasn't an issue in India, was zero, how much interest would you demand on money? Like, if I say, like, give me, 1 lakh rupees for a consumer and put it away for one year, how much interest would you want if the inflation was zero? And I would say that we would argue approximately 4%. You have to give me 4% to take my money and put it away for 1 year, right? So interest rates for consumers are not zero. The real rate of interest in the economy is not zero. It's about 4%, right? So that seems like a reasonable goal, that the rates cannot be out of control. Right? But under COI, the policy may get distorted. So, for example, after GFC, which was again caused by some foolishly optimistic real estate market appraisal that real estate doesn't go down, that's a different story. Nominal interest rates were kept at zero for 12 years. 12 years. Now, can you imagine it happening in India? The interest rate is zero for 12 years. Now, I agree we're at higher inflation rates, so we should not keep it at zero. But I don't even think that we'll get it to 2%. No chance. Now, one could argue, so what? They were trying to control inflation. We'll come back to that in a minute. But can you imagine, in India, the people after they retire, their FD rate goes to zero? That's what happened. FD rate went to zero. How will they live? What will they do if the interest rate goes to zero? So this also is true in the US. आप सुनते नहीं हैं, लेकिन ये बात यहाँ भी है कि you look, they went into McDonald's, they went into stock markets, they did all kinds of speculation very late in their career because they didn't get any money. But why was this done? आप बताइए, why is the interest rate zero for 12 years, in a distortionary way? Because financial houses wanted easy money. Once they got addicted post GFC, they didn't want to let go. And when revolving doors beckon, nobody wants to upset the financial houses. That's what happens. That's why it's distortionary. Now, let me suggest to you that it was, in fact, because of the COI and not really because of any principled approach. It may be, but the evidence doesn't point to it. So let me tell you why. If you see inflation post GFC, till the COVID hit, which is a different story, inflation was running at about 2%. Look at the right side of this chart. It was running at 2%, right? Unemployment rate, which is another important number that the Fed keeps track of, was running at extremely low levels post GFC. It was a steady downward trend, but 2.5%, 3%, which is really very low. So you tell me, if the interest rate, if the inflation is running at 2%, if unemployment rate is running downward trend persistently, why are interest rates kept at zero for 12 years? What is the rationale? If inflation control mein hai, the unemployment rate is looking healthy. Why are you keeping it at zero? Why is this a reasonable policy? Is the question that we have to ask ourselves. So there are behavioral consequences of zero interest rates. But the problem is, if the FDs are giving you zero, what do? You reach for yield using questionable schemes, because everyone wants yield. Yield matlab money has to work for you, right? Not everyone has a steady income. There are lots of people who basically rely on these things, particularly the older generation, senior citizens. They speculate using questionable schemes. They speculate using stock markets. Bitcoin scandal, the same thing, right? The build up and collapse. Why Bitcoin scandal happened? Because interest rates are zero. Money is not working, right? So it leads to bubbles in risky assets. Now, these bubbles, what they do is that they interrupt economic growth when they burst. People lose money, and then there's calls to regulate sectors, or people lose money. They're scared to invest in legitimate investment opportunities. And that means that corporations' cost of capital goes up, which interests economic growth. Other problem with people is that they take part-time jobs when they're not physically healthy, like older generation, they don't get FD rates meaningfully. So they have to go around working when they're not physically healthy. They should be enjoying life. So if you look at all these things, both from a human capital standpoint, when you're not physically healthy, you shouldn't be working. You go take jobs, that creates human capital risk. And the speculation in questionable schemes when you want yield, risk bearing of individual consumers goes up, and that's not very healthy for the ecosystem. Okay, so these are the points I wanted to make, that everything is not to be, I know that India has moved on tremendously, but copying from the West, in my view, sometimes I see that they completely lack common sense in their regulatory policies, which I see very much so when I talk to Indian regulators, whether they understand what the deal is and they know exactly how to set up a system. Now, I understand that some of our own RBI governors have gone on board of directors, but I cannot think of a single example of RBI governors and RBI executives going and taking full-time jobs at financial houses in the way that we see in the system. So to conclude, I would suggest that optimal financial regulation must incentivize good management and not micromanage, but set broad guidelines that the banks must monitor interest rate exposure in a proper way using proper quantities. I think that the SVB CEO was asked about duration. CFO was asked about duration, and he or she didn't know what it was. So I believe I read that somewhere, although I'm not sure. If that is true, then that is quite a scandal. That has to be somehow imposed. I also think that there should be political pressure on RBIs, although RBI people are very competent in my view, and particularly on the Federal Reserve, that this laissez-faire approach in the Fed, that you can do whatever you want, should not remain unquestioned. There should be pressure imposed. What are you doing? Do you know what you're doing? and not just rely on their degrees from Princeton and Chicago or whatever it is, and say like, you know what you're doing, do whatever you want. I think that that can lead to some undesirable outcomes. And finally, I don't think revolving doors should be prohibited, but we should have some reasonably sensible rules key what you can do and how you can do it post your regulatory life. I think these are very important issues, and I think that our regulators, policymakers, and academics should continue to debate them. But enough is enough, and these points did need to be made. Okay, that's all. So thank you so much.
Thank you,
and
thank you, Professor. Thank you, Professor Subrahmanyam.
Yeah.
I must really heartily congratulate you. I mean,
thank you, thank you, thank you.
Your presentation was just spot on,
and
just absolutely, just it. Great, congratulations.
Thank you so much.
I mean, there could have been nothing more said, and you have really done a wonderful job in summarizing the whole thing in just 20 minutes. Very good. I have some comments I'd like to make here. Incidentally, contextually, this particular thing which happened, it is not the first time it has happened. It has happened many times in the past, in 1980s, 1990s, 2007, 8. And I am reminded of a very famous, quote of Michael Lewis in Liar's Poker. He very famously said, he called it 363 syndrome. 363 syndrome means borrow short-term deposits, borrow short-term money, deposit 3%, lend long, higher asset duration at 6%, and off to the golf course at 3 p.m. So this is the best summary of what Sharon has rightly decided to call it, the duration mismatch. So this is the classical example of duration mismatch. I would also, with that, I would like to say here, I think we can definitely be more clear about it. I mean, the modified duration.
Right.
In fact, the duration divided by 1 plus y is modified duration, and that gives a linear relationship for a percentage change in the interest rate. So you can straight away multiply, the percentage change minus a plus modified duration, and you get the percentage change in the price of the asset. Another thing I would like to introduce here, just to for the information of the participants and the audience here, and also the speaker, that I talked about it a long time back in my paper on asset liability management back in 2000, and Reserve Bank implemented some of it. The modified duration of equity net worth. So that gives, like suppose you have 90% assets, 10% liabilities. Then your capital is 10%. So 100% is assets, and 90% is the liability, and 10% is the capital. That gives you, for 10-9, it gives you a modified duration of equity about 29 years. That means if there is 1% shock, increase in interest rate, then straight away, instead of forget about assets and liability duration, because they already, as you rightly said, they're time weighted, this is weighted, PV value weighted time, this is weighted average time, which is the duration. So 29% of your equity, so it gives a much better insight into the risk. Because ultimately, every risk translates into risk erosion of the equity. So this was introduced by the Reserve Bank of India, and the Reserve Bank of India fixed the maximum tolerance limit at the regulatory level of 18% decline in equity for 2% increase in interest rates. So that means it gives you, per 1% means it gives you indirect idea of that the bank should not exceed, bank's modified duration of equity should not exceed 9 years. It measures in 9 years. So that I think is, this is the beauty of this modified duration of equity. It captures, it combines the effect on the liability side and asset side of change in interest rate, and gives you a number a banker should be concerned with. So like this guy, I mean, this SVB, they would have known that they lost about 90%. How much the capital rate? 74, 80% of the capital. So that they could have got an idea about this. It happens, so what happens. And finally, I would say that convexity. Convexity, I think, is add-on. That makes the whole risk measurement very accurate, especially when the shifts and changes in yields are high. because positive convexity adds reduces the duration, the effect, and the loss will be limited to the extent of higher convexity, where the negative convexity will work in the opposite direction. So I think this kind of things, that complete your presentation with my some additions that I have made. So with that, I will now request Mr. J.K. Dadoo to kindly make his presentation. Thank you so much.
Thank you very much, Mr. Sharma, for your introduction and for the excellent presentation of Professor Subrahmanyam.
Thank you.
Now, I have read about 25 different articles on this subject, and I have 6 factual points to make, 6 propounded theories of experts, 10 fundamental questions for US, and 10 fundamental questions for India and the rest of the world. I'll take about 20 minutes and I'll try and cover everything that I've researched.
Please, please.
Number one, it's very ironical that a country which imposed sanctions on Russia has tanked 3 banks, and 5 banks are on the hit list of Moody, while the Russian bank coffers are filling daily with Russian dictated rubles for oil and gas purchases. Is the most ironical thing that I notice in this entire situation. Now, as regards the 6 factual facts, SVB did not have a risk officer for 8 months, and it had the temerity not to disclose this to the regulators. This is scandal number 1. Scandal number 2, 90% of its deposits were uninsured, making it extremely vulnerable for flight of capital by venture capitalists, in whose favor it was tilted very heavily. Number 3, it had no interest rate hedges on its massive bond portfolio. So it lost 95% of its market share. Just weeks before that, or days before that, Silvergate Capital Corporation, the crypto industry's big bank, had collapsed. And if this is not enough, the Signature Bank was the 3rd casualty, by which time Fed actually woke up. Now, we must also know that there are 5 other regional financial firms which are under review, like the Western Alliance Bank Corp, Intrust Financial Corporation, UMB Financial Corporation, Zionsk Bank Corp, and Comerica Incorporated. These 5 lenders were also relying on uninsured deposit funding and unrealized losses in their asset portfolios. Now, time alone will indicate whether Moody is right in his assessment of these 5 financial institutions. I now come to the 6 theories that have been propounded by various experts. The first theory that Thomas Henning says is that US monetary policy played a pivotal role in this, and as it suppressed the yield curve and sent wrong signals to the banking industry. Consequently, banks bought government securities in bulk to hold them till maturity. And Silvergate and SVB were the greatest casualties because they focused on boom-bust sectors. The second and the most worrying theory is that SVB's top executives, including CEO Becker, sold $4.5 billion worth of stock just hours before the crash, obviously suggesting insider trading. If you look at the First Republic Bank, which followed suit, its top executives sold millions of dollars of shares 2 months before they plummeted. The chairman, Herbert, sold, I believe, $4.5 million, and $7 million was sold by its president, Thornton, credit officer, Lichman, and CEO, Roffler. Now, Fed had to pump in $30 billion to rescue this bank, as its shares nosedived by about 58%. Justice Department has been roped in to check all the insider sales. And I believe this particular bank is also in a big crisis now, despite all the infusion of funds. The third theory that I want to highlight is that a fortnight before SVB collapsed, KPMG LLP gave it a clean chit despite Moody raising its concerns. Lynn Turner, the ex-chief accountant at SEC, says that this is a big concern for scrutiny and inquiry. Our own watchdog in India, Sucheta Dayal, after looking at all this in great detail, says that US regulators are more incompetent and compromised than ours. But they act super fast. The lobbyists rule the country, privatizing profits and socializing losses. Now, the fifth theory is by our Swarajya, which says that there were fiscal and monetary follies to a very large extent in these bank crashes. I come to the last theory, and this is about credit squeeze, where they tried to contact 10,000 wealthiest clients to pacify them, but they couldn't manage that. And T.C. Raghavan and the Swaraj reports that CS dealt with hidden funds of clients who indulged in serious drug and financial crimes, and such illicit transactions led to its doom. So these are the 6 theories. Now I come to my 10 fundamental questions, which I think are very, very relevant in the context in which we are speaking. My first question is, if the top bank executives suddenly start offloading their large holdings, knowing the health of the bank, what are the best checks and balances for this, including advance information to the bank boards and the SEC? My second question is, if you are having such rapid growth as SVB had, then is it not worthy of a yellow flag, as the ex-governor of Fed, Daniel Tarullo, has said, that high risk or excess growth and excess risk should not go hand in hand? My third question is, Jared Seiberg, who found both SVB and Silvergate had less onerous liquidity rules which could not match their retail deposits, foreboding catastrophic losses. Should the Fed not have been careful at these rules? Number 4, Timothy Coffey explored and even concluded that US regulators knew unrealized losses in bank security portfolios will lead to trouble, but turned a blind eye. Couldn't the regulators undertake timely steps? And if not, why should they be absolved of their accountability? Question number 5, FDIC, which Professor Subrahmanyam alluded to, is the only agency which pointed out in end 2022 that the entire banking industry had $620 billion in unrealized losses on securities, implying that the rot had set in by that time and jeopardy was not gaping at just 3 banks. Then why was FDIC not taken seriously by Fed, and who's squarely responsible for this? My next question is, what happened to Basel and capital adequacy norms in terms of all this? We talk about capital adequacy norms, we talk about Basel 1, 2, 3. What's happening to all that? Is the system completely immune to all that? My next question is, while Justice Department and SEC are now investigating these bank failures, what set of guidelines should the Senate pass to ensure that no one down the line in future can cause such untold damage to the US public and to the world at large? Next, Morgan Stanley's assessment is that funding for startups henceforth is not going to be easy. Gary Ten has calculated that unicorn startups need $300 billion and smaller ones need $1 billion market, smaller ones with less than $1 billion market cap will require $250 billion this year alone if 16 million US employees at these VC and private equity owned companies don't have to lose their jobs. My next question is, what is the out-of-box solution for them? Will the startups be forced to draw resources from secondary transactions at deep discounts to prior formal rounds? My second last question is, there is a big fallout of all this in terms of a fear of recession. Many people are now questioning whether Fed has further capacity to increase interest rates. As Delis Temos has inquired, whether banking industry, which has gone off the Washington's radar, would ever regain the confidence of this government. My last question is whether 50 basis points hike by President of the European Central Bank Lagarde was correct or not. Because in the wake of this crisis of confidence in credit swayers, the contagion effect on at least two major European banks like Societe Generale and BNP Paribas has been equally strong, and they have lost share value tremendously to the extent that Paris Stock Exchange had to be closed on a particular day. Both are now looking for government support. Will they get the support is $1 trillion question, because PNB Paribas has an AUM of $2.7 trillion. Now, moving on to the questions which relate to India and the rest of the world, I'll quickly run down my 10 other questions. It is now substantially clear that fears of global consequences are reaching Canada, India, and China after touching France, EU, and UK. In UK, as you know, Chancellor Hunt got 180 technical companies complaining about loss of deposits hitting the banking industry terribly, as reported by Bloomberg. And no wonder HSBC stepped in to buy the SVB branch of UK for a measly £1. The other point which was raised by Bill Ackman was that while he pounced on Adani for the Hindenburg report, he was the most vociferous demanding bailout for SVB. Why such contradictions in life? Why such double standards? I want to ask Dr. Raghuram Rajan, who's a renowned professor in finance and marketing and economics, when he says he has no clues about bank collapses in US. How does that happen? I want to ask Joseph Gentile, the chief administrative officer of SVB. He had a dubious past as the CFO of Lehman Brothers. What was he doing as chief administrative officer in SVB? And what was his role in the whole game? To the Minister of State for IT, Chandrasekhar, who spoke to 450 startups to find ways and means to assuage the feelings of hundreds of Indian startups affected by this global chaos. And he wanted Indian banks to help the startups. Now, I feel very strongly about this because funding by the Ministry of Department of Industrial Policy and Promotion for Indian startups is quite huge, and funding by Indian banks will expose India to unnecessary risks as economic flu, to my mind, catches instantaneously. Now, we in India also must know that SVB had an 800 manned technical center in Bengaluru with services provided in engineering, analytics, and testing. What will happen to all that, God alone knows, and it's a matter of serious concern. Now, an offshoot of all this is that stocks have become, again, the stocks have lost credibility very badly. And no wonder in India you find gold prices have touched to 62,000 rupees per 10 grams from 50,000 rupees a year ago. So obviously you know where the money is going now. Now the Department of Economic Affairs Secretary says that Indian banks are well capitalized and well regulated. While it may be true, he has not answered their request to lower the dividend payout demands this year to enable them to strengthen their capital base. So therefore, there is a bit of a fear in the Indian banks too that their capital base is not adequate. Now I come to my last 2 points or last 3 points. Number one, are sanctions or have sanctions on Russia served their purpose? Now, is G7 or G20 looking at this carefully when Argentina is in an inflationary spiral and 50 countries are crying for debt relief? I have suggested in my article in Business World that we must have a 3-member apolitical Nobel laureates committee, one each in medicine, economics, and peace, appointed by the United Nations to do a quick audit of sanctions on Russia for the world at large and not from a US-EU perspective. Secondly, cryptocurrencies are ruining the financial stability of the financial freedom of this world. They should be banned globally, and e-currency should be started by central banks of all countries. Otherwise, more skeletons will fall from the cupboard and there'll be no place to hide them. My last point is what Warren Buffett has recently stated in his press address. He's blamed politicians, regulators, and the press for the bank debacle. He says the executives of the banks were more interested in getting rich than looking after their customers' interests. And to conclude, I would only like to say what the Treasury Secretary says, and I'm extremely surprised at what she's saying. She says there's no money to pay bills from the 1st of June unless the debt ceiling is raised, and the debt limit has reached its peak in January 2023. Now, imagine the debt limit is $1.4 trillion. And she wants an increase in this debt limit, which is more than the GDP of US. I don't understand how US functions. I don't understand how the financial system functions. And I don't understand who is the real watchdog. Is US printing money by lock, stock, and barrel and creating a furor in the whole world? Somebody must stop this debacle, otherwise it will flow into the entire global scenario. Thank you very much.
Thank you, Mr. Dadoo, for your wonderful presentation, with which I could not agree more. And I must say that there is nothing to my mind left which has been left uncovered. Thank you so much for that. Incidentally, I'd like to refer to this about when you mentioned about the very quick rise in the profits, asset size of the bank. There is a very famous saying, and I have tweeted about it: "The steeper the rise, the steeper the crash." The steeper the rise, the steeper the crash. And also, I could not agree more with you on cryptocurrency. I have been a very strong advocate of that cryptocurrency should be banned. Even the Governor Reserve Bank Shaktikant Das also has said that cryptocurrency should be banned. There is no question. See, once you agree to regulate any particular asset or something, what you are indirectly telling is you are formalizing it, you are legalizing it. You can regulate only what is. You can't say you'll be regulating ganja and all that kind of narcotics and all that. You don't regulate that because that is to be banned. So you regulate only what is legal, what is proper. So I think that's a very important point you have made. And I must say that again, your presentation too was just spot on, and it was just it. Congratulations.
Thank you very much.
So now I will request Anil to please come forward and discuss the points made by the speakers and add his own perspective.
Yeah, thank you very much. I'll make 3 quick points, and then maybe I'll have a couple of questions. The first point is with respect to the fact that the duration gap analysis is used to measure the interest rate risk in banking book largely. In India also currently we do that. But now implementing it has become a bit more complicated. Why has it become more complicated a bit? What are the limitations it has? Do we need to look beyond what we are doing currently? And third point would be, where do we stand in India currently on this? Now, in today's world, as we all will agree, the stability of an entity, a regulated entity, a bank or a non-bank, or a financial system primarily depends not only on its own fundamentals or the macroeconomic situations of that system, but it also is affected by the global factors, the geopolitics, the geoeconomics, the embargoes or the sanctions which are imposed, and the wars which take place, and the supply chains which get disrupted. So that's part one. And accordingly, the interest rate risk which a financial entity is exposed to also depends not only on the nature of the assets and liabilities it carries on its balance sheet, but is also affected by all these factors, and increasingly by the monetary policy actions of the central banks, both quantitative easing or quantitative tightening, as we have seen in the last 12 to 15 years. Now, taking a view on the direction of the interest rates, what direction the interest rates are going to take, is central to the success of duration gap analysis. And taking this view on the future interest rate scenario has become all the more complicated on account of these factors which are there. That's a part one. So accordingly, it has become a little bit more 360-degree, a little bit more non-linear than it has been in the past. Now, duration gap analysis has served us, for quite some time, all these years, but it has its limitations, sometimes primarily flowing from the duration duration element of it, and primarily the way it's implemented. For example, you have to take a view on the future interest rates, what they're going to take. It largely accounts for it doesn't account for very large interest rate shocks. The kind of shock. So the kind of shock which we have seen, 450 basis points in US, for example, and elsewhere in the economies. Duration gap analysis, the way we are implementing, is primarily more broad-based, where the assets and liabilities are grouped into various categories, and then the modified duration is calculated for each category, and then the overall impact on the market value of equity is calculated. We also need to account for more non-parallel shifts in the yield curve, which happen not only because they are more realistic, and that is how in reality the yield curve will move for any given change in the interest rate, but also increasingly because central bank actions. The central banks are deliberately buying short-term bonds, selling long-term bonds, and vice versa, and impacting the yield curve in a manner which is not parallel. So it has become that much more complicated. And we also need greater granularity in terms of the data, and it should also be able to capture the cash flows, what cash flows in terms of assets as well as liabilities, whether that would be a more better approach, apart from the fact that we need more scenarios which are based on empirical data and which are also based on hypothetical data. Like, for example, a 450 basis point interest rate shock, wouldn't have been practiced under the duration gap analysis. So if this be the situation, where do we stand? Now, as most of you would be aware, that Basel committee came out with its recommendations on the management of this interest rate risk, which builds up on the banking book, which normally is not marked to the market primarily in 2016. But the implementation of the revised guidelines was held in abeyance on account of various factors, which we are all aware of. But now in India, we are moving to rolling out these new measure for managing of the interest rate risk and moving beyond duration gap analysis. As elsewhere in the economies, possibly, we have been having a traditional gap analysis and the modified duration gap analysis for managing the impact on the net interest income of the banks, and also on the value of the equity of those banks. And the new framework, apart from the fact that the board would be primarily responsible and they will be overall approving the policy and overall monitoring of the interest rate risk, which is bank is taking and how it's managing. And of course, ELCO would be acting under the board, and the bank will have a clearly defined board-approved policies, risk appetite statements, etc., etc. The risk measurement primarily will change based on the scenarios. And what are the scenarios? There would be internally selected interest rate shock scenarios, primarily flowing out of the ICAP, condition of the bank. The risks or the extent of the risks which the bank is carrying in its ICAP document, the Pillar 2 document, Pillar 2 of the Basel Accord. So some internally selected interest rate shock scenarios flowing out of the ICAP. The second would be the historical and hypothetical interest rate stress scenarios, which are more severe than the shock scenarios which have been selected under the ICAP. And the third element or the third set of shock scenarios would be the 6 shock scenarios which the regulator will prescribe and which have been prescribed. So in addition to one standardized shock, which we have been currently having under the duration gap analysis, now we'll have a series of internally selected historical and hypothetical stress scenarios, and also 6 prescribed shock scenarios by the regulator. And since the yield curve varies from currency to currency, so banks would be required to calculate, undertake these scenarios in each currency in whichever they have material positions. The bank will be required to develop an effective stress testing framework as part of their broad overall enterprise-wide risk management and governance process, which would be in line with their size, the complexity of the balance sheet, etc. And it should eventually feed into the decision-making process. Now, the outlier banks, what would be the outlier banks? The outlier banks primarily would be the banks which generate the value of the equity declines by more than 15% of the tier 1 capital under any of the 6 prescribed interest rate scenarios as part of the shock scenarios. So, which is much more, tougher than currently what we have. And of course, there are disclosure requirements. Apart from the fact that the board has to be kept informed of the situation, the banks also would be required to disclose the changes in the value of the equity, as well as their interest income in the prescribed statements. Now, the changes which will flow from this new scenario would be that earlier we had 10 buckets for the cash flows under the duration gap analysis. Now, under the new system, we will have 19 buckets. There will be various models on behavioral assumptions for the non-maturity deposits, fixed rate loans subject to premium payments, and term deposits which may have an early redemption risks, etc. There are, with respect to the caps on the maturity of core deposits and the average maturity of the core deposits, which were earlier taken as a broad measure of 95% of the savings bank and 85% of the current accounts, which now have been prescribed in terms of the retail transactional deposits 90%, retail non-transaction 70%, and wholesale deposits 50%. And so on. There are other changes with respect to the cash flow slotting of the term deposits and cash flow slotting of the fixed rate loans as well, which are both based on the behavioral models. The impact on the net interest income of the bank, which was earlier a 1% change on the duration gap analysis, and a 1% change on the interest rate risk for all currencies. Under the new scenario, it would be for the Indian rupee 2.5% interest rate shock, and for the US dollar and euro, it would be 2% interest rate shocks. With respect to the outlier banks, as I mentioned, under the new scenario, it is 15% more of the tier 1 capital getting impacted under any of the 6 prescribed scenarios, as against 20% or more of the capital and reserve getting impacted under the duration gap analysis. And with respect to the methodology for computing the change in the market value of equity, currently as is the duration gap analysis, but now under the new system, we will have the fair value approach of the risk sensitive cash flows. And with respect to the shocks, as I said earlier as well, we had one standardized shock under the duration gap analysis. Now we'll have the 6 prescribed shocks, apart from the internal shocks which the banks will prescribe. So this broadly, I wanted to bring on table the scenario with respect to the management of the interest rate risk and moving from duration gap onto the present framework. So with this, I'll stop with respect to my comments. But the question which I have for Mr. Subrahmanyam is that with respect to, we again go back to the SVB.
Yeah, go ahead, please.
Yeah. We all know that it ran a huge interest rate risk in its banking book due to the unprecedented shock of 450 basis points increase in the interest rates. And it may or may not have been doing the duration gap or any other analysis to manage the books. It may not even have be hedging its positions. It was not required to, probably. And the balance sheet also could have been unbalanced in terms of the fact that it was largely concentrated by the IT companies, and largely investments were in the long-term bonds. But do you think that if the Fed had a liquidity arrangement whereby it could lend to the banks under stress against the long-term bonds which they were holding without applying excessive haircuts, the bank could have been saved? So it was one piece missing which was there. And secondly, when Fed increased the interest rates for 50 basis points in a short period of time, while it was fully focused on managing inflation, understandably, could it also have cautioned the banks or flagged the risk which the banks would be exposed to with such a massive shock in the interest rates in such a short period of time? Probably it could have alerted the banks, and probably they could have been more on their guard. Thank you very much.
Apologize. What was the second question? The second question wasn't clear.
The second question was that while the Fed when the Fed was increasing the interest rate,
right.
It was focused primarily on combating inflation, understandably, but could it also have flagged the risk it was creating for the banks? Was it flagged? Was it not flagged? Of course, it was the duty of the banks to take that risk and take remedial measures, but the Fed also probably missed that particular point, or did it miss, or did it not miss?
So, Mr. Sharma, should I answer the question now or wait for
a... Please.
Okay, so all right. So the question is posed to me. Thank you so much for the enlightening discussion. And see, the kinds of things that you're proposing and we are implementing is obviously the kinds of things that should have been done. But as Mr. Dadoo said, and Mr. Sharma, the point is that, like, I don't understand how the US works, he was saying, right? And to be honest with you, I understand how it works, but I can tell you this, that the level of analysis that you propose, Mr. Sharma, is nowhere close to the kinds of analyses that even the Treasury Secretary is doing at this particular moment, from what I see. It's a peculiar situation for an advanced economy. It's more like the Roman Empire right now, where literally the thought process, essentially, it's possible that the Federal Reserve in its meetings discusses these issues. But if you start asking them about 6 different shocks for different currencies, non-parallel shifts in the yield curve, I don't even think that they're going into that level of depth when they're thinking about regulating the sector. It's a peculiar problem because it happens in a binary political system that everyone is essentially asked to just choose a side, either you're left or you're right. And once you choose a side, then everyone chooses sides. So like the mayor chooses a side, the Federal Reserve board members choose a side, the CEOs choose a side. And once a side is chosen, then essentially the side is loyal to that cause. And so it's a system where the SVB simply won't be told what to do or how to sensibly manage its risks if it sticks to its tribe, it sticks to its side, okay? And even the justice system in the United States is not by any means blind, in the sense that you have the old lady holding the Supreme Court thing, holding the scales, and the scales have to be balanced. None of those things. The key problem is prosecutorial discretion, and Ms. Dadoo alluded to insider trading, not happening. They will not be prosecuted because they are on the left side of the tribe, left tribe. And so it's a very, very discretionary prosecutorial system. Our CBI may be somehow under political pressure on occasion, but it's not like this. So अगर आप लेफ्ट पे हो तो कुछ नहीं होगा, कुछ नहीं होगा, आप जो करना करिए, कुछ नहीं होगा. जैसे Rajat Gupta, they pursued him, right? Because he didn't pick a side. Had he picked the right side, I'm telling you, nothing would have happened. Side pick kariye, stick kariye. This is what's going on.
Mr.
And I'm saying,
Anil Sharma, I have a small question for you.
Let me finish the answer to the question. The point I'm trying to make.
Sorry.
So liquidity arrangement, the point about the liquidity arrangement is that if you do lend to the banks who are under liquidity stress, the problem this creates is that how do you make them pay it back? If they go under more stress, the lending will be counterproductive, and the political pressure will be again the same, that, well, if they fail, they fail. So it was not going to be solving the problem of the duration mismatch in the beginning. It's a temporary stopgap solution. And if the deposit run continues, then they won't be able to pay back the loan. So it doesn't really solve the problem. So that's not, I think that type of fix will not work. With regard to the 450 basis point increase and the warnings and so on and so forth, the regulators and the Federal Reserve interest rate policies are not communicating. They're pretty much orthogonal. And so when Powell decides to raise rates to combat inflation, the communication with the SVB types is simply not there. There is no way in which they can communicate that this is happening, please control yourself. Another problem that I see in this economy is that people are mostly in the present. Nobody is thinking that 6 steps ahead, this can happen. Let's have a warning. Let's have a system in place. There is a complete breakdown of thought processes for the long run and a system of checks and balances. This is where we are. I'm sorry for the long answer. I apologize. Please go ahead.
Mr. Anil Sharma, can I ask you a small question, if Mr. Charan Singh permits?
Yeah, please go ahead.
Mr. Sharma, I read the interview of the DEA Secretary said, where he says our banks are well capitalized and well regulated. The banks asked him, please lower the dividend payout this year so that we can strengthen our capital base. How strong is the capital base of Indian banks is a question which every Indian wants to know. Can you answer that, please?
I think the capital ratios of the banks in India, as you know, we have the banks which are in the private sector and the banks which are in the public sector. Now,
Yes.
if you look at the banks, I don't have the data currently with me, but if you look at the major private sector banks, then most of them have capital ratios which are maybe in excess of 15% and above. I'm talking broad numbers, and which is very comfortable position. And the tier 1 ratios are also substantially high. When it comes to the public sector banks, then the ratios are comparatively lower. They are operating at around 12%, 13%, 14%, depending upon which bank we are talking about. But you can roughly say that the public sector banks have capital ratios which are around 13 to 14%, 12%, 13% average. And the tier 1 ratios are comparatively higher. The tier 1 is the actual capital which they hold. They are not the subordinated bonds and the other debt which they have raised as the tier 2 capital. So and the public sector banks, as you know, are owned by largely by the government. So so that's part one in terms of the numbers. So if you look at the minimum capital adequacy ratios, the Basel norms, etc., the banks are adequately capitalized both in the overall ratios as well as in terms of tier 1 capital. There is no
Just
issue.
one supplementary then. Just one supplementary. If that is the case, why are the Indian public sector banks requesting the secretary, please take a lower dividend payout this year because we want to strengthen our capital base, if the capital base is so good?
Yeah, I'll answer that question, and that question that is coming primarily from one major reason, and that is that under the Ind IAS, we are proposing to move to the expected loss provisioning, wherein when there is impairment in an asset, then you not only make an assessment over a short-term period, but also over a 1-year horizon. And if impairment exceeds a particular point, a particular percentage, then you, over the entire life cycle of that asset, you have to assess the impairment and also provide for it. So this expected loss provision, which is going to kick in under the Ind AS, is going to increase the requirement for provisioning. For that, they will require capital. So that's one major factor. They are saying that we need, probably lower. I'm not aware of this issue, but I take it whatever you are saying is correct. So this could be the reason why they're saying that.
I hope what you're saying is correct, because this has caused a lot of concern in the Indian knowledgeable financial sector, how good our banks are in terms of their capital base. Because a dividend of 1 year, if that is going to strengthen their capital base, then obviously there's something seriously wrong.
I think the dividend of 1 year can have a substantial impact on the capital ratios. That's not the point.
Okay, I take your word for it, and I hope we don't get saddled with any kind of losses that US has put on the entire global system through the Ukraine war, and unfortunately the pandemic has caused a lot of stress. Thank you.
Anil, I'd like to come in here. Anil, can you hear me?
Please, sir, go ahead.
See, you made some observation. One, you said a 15% decline in equity. For what interest? What increase in interest rate, and where that increase comes from?
Please say it again.
That 15% you mentioned, a 15% decline, erosion in the value of equity.
Yeah.
For what increase in interest rate?
That would be as per the interest rate shocks, which is
No,
Indian interest rate shock of 2.5% and USD and Euro of 2%. And the shock scenarios which are prescribed, the 6 shock scenarios which the regulator has prescribed, and the other shock scenarios, as I mentioned, internal, depending upon the ICAP, document, as well as the historical data.
No. What I want to make, what point I'm trying to make is, I'm talking about the Indian rupee. Forget about the dollar and euro and all that. In the case of Indian rupee, the 6 shock scenarios. What are these percentages there?
I'll have to check the document on that.
No, but my point is, I have some issue with that.
This circular, sir, is in the public domain, so probably it would be part of that circular. And
I'm coming to that. Is my view that there is a very standard and reliable method of calculating. You must take 2.33 sigma. 2.33 sigma covers the black swan situation also. So you take a long period of 10 years, daily changes in interest rates, a particular this thing, and then you work out the mean and the standard deviation, and then use 2.33 sigma to work out the worst possible shock. But otherwise, very arbitrarily, 6 scenarios, 2%, 4%, 6%, 5%, 10%, 12%. It doesn't work that way. Where does it come from? There should be some logic to it.
Okay, I've just opened the document. See, there are the shifts in the yield curve which are there. Parallel shock up, parallel shock down, steepener shock, flattener shock, short rate shocks up, and short rate shock down. So these are the yield curve scenarios which have been prescribed. And the specified size of the interest rate shocks is for all the currencies. For Indian rupees, for the parallel, it is 250 basis points. For the short, it is 300 basis points. And for the long, it is 200 basis points. There are for other currencies also, but as you said, for the rupees, it is these shocks.
300 basis point is the largest shock.
In the short, long is the 200 basis point, parallel is 250 basis points.
Which one is the parallel is 250 basis points?
Yes, sir.
But
you can see this document. It's available on RBI website.
I know. What I'm saying, I just wanted to go because you just recently retired, so I thought you'd have a better sense of where it is coming from. That was my point.
Yeah.
Okay. Now, so I would still suggest that we should use that standard, method of calculating the standard deviation of a very long 10-year period, 5-year period, and we can even do time-weighted, what you call log normal distribution, where you assign higher probability to the recent development. Suppose recently the volatility has been very high. That's another way of taking into account a better estimate, forecast of the expected shock, and that comes very close. Second point is you mentioned about, we are going back from duration gap analysis to some, again, the bucket based flows and earnings perspective. I think we made a very great transition from earnings based perspective to economic perspective, where because the economic perspective, which affects the modified duration of equity, is subsuming the as a subset the earnings interest perspective also. You have to say something on this? Hello, can you hear me, Anil?
Yes, sir. I thought you were making a point.
No, I have made the point. What do you have to say on that?
No, I have no view on that, sir. I
Okay.
mean, you are the master on that.
That's what I'm saying. I mean, this is something we should modify duration. We should even introduce now convexity, and we have synthetic, a measure of risk of the entire balance sheet, accounting for the interest rate risk and interest rate shock. That's my view. Any other questions from the audience?
Yeah, they could raise a question either in the chat box or raise their hand. But sir, in the meantime, I had a quick. Well, there is a question from somebody from Bangladesh who is asking why bank regulations are so weak in the US. So that is one question which I leave it to you, Mr. Chairman, whoever you want to allocate. In the meantime, sir, I had one observation to make. My thought is that given the Indian banking system, which is overcapitalized in the sense that we follow something plus the Basel norms, so the risk factor within India are minimum. The second thing that I wanted to mention is, and Professor, you may like to tell us about it, is that yes, the interest rate hike was very aggressive by the Fed Reserve, but what we have seen are the four banks which are in crisis. But of the four banks, the duration story is only applicable to the Silicon Valley Bank, because the Credit Suisse was a story of difficult times, going ahead difficult. Signature was more for the crypto, but the interest rate hike directly hitting the balance sheet was only for the Silicon Valley Bank. So should I imply that the commercial banks in the US, other than the Silicon Valley, they have taken care of the duration mismatch and are not under very high stress? If that is so, then for the rest of the world, it is something to be confident about and not too worried. But if that is not so, then a contagion would be on the way, and sooner or later, we are all going to be drowned. So I wanted to know your views. Thank you.
Mr. Sharma, please tell us who should go next.
The question is asked, addressed Mr. Professor Subrahmanyam, no?
Okay. So my brief thoughts, I know that we have limited time. So let me just tell you that the biggest risk is deposit runs, right? So like the Nobel Prize was given to Diamond and Debye professors just to argue that deposit runs are contagious. So the danger here is simply that SVB creates a panic that there is an asset liabilities mismatch in banks around the world and there's a deposit run. Deposit runs are extremely dangerous to banks because that's their lifeblood, right? Like that's with the cash on hand to do whatever else the banks do. I'm being oversimplifying it throughout today because I think I need to keep it to the basics at least. So the deposit run is an unknown quantity. It's not possible to foretell what will happen. But I really do think at this point, the situation is slightly more stable than it was 6 months ago, that I don't think that we're going to see a situation where people do a deposit run. But that is something to be monitored, that if we're reaching a point where people are totally panicking. But it's also important to reassure oneself and say, like, money has to be somewhere. So everyone cannot pull their deposits from everything at the same time. And the banks that are going to survive this are the banks that are brand names that are well known. And so I think that the international houses will be fine. But the key thing to watch for is the deposit run and the depositor's mental state, more or less, behavioral state. That's true. The interest rate hike I would comment on was aggressive, but really they didn't have any choice. So the behavioral story on the interest rate hike is very simple. When COVID was going on, the democratic governments in the United States gave a lot of free money. For example, everyone working for various organizations, university, educational institutions, and students got $600, which is basically for free into their bank account, no questions asked. Everyone got $600. Every student in the entire California system. So naturally, when the government doesn't care about deficits and just wants to help people, give them free money, then money will build. What is the result of that? We all know from basic macro that inflation will build. When inflation is running at 8%, the government doesn't really have a choice but to do something about it. So Powell really had to do it. There was no choice, right? And so, that's essentially what happened. But the impact of free money was too sudden. Suddenly, we have this free money floating around. So that's why the interest rate hike was sudden, but the sides didn't talk to each other. So nobody said like interest rates are, there's a 450 basis point hike. Let's warn the banks that duration mismatch won't work anymore. No, nobody thought of doing that. That was the missing link. And the checks and balances, as Mr. Sharma pointed out, did not exist to the level of sophistication that he's alluding. That's it. Thank you.
Mr. Singh, can I take a minute to answer what you wanted to what you asked?
Yeah, please.
The research that I have done shows that Moody has put 5 regional firms, as I mentioned, on the block because these 5 lenders were relying on uninsured deposit funding and unrealized losses in their asset portfolios. So it's not only SVB. If you look at Moody, they are the most meticulous in pointing out which banks or which financial firms are in trouble. So these 5, Western Alliance Bank Corp, Intrust Financial Corporation, UMB Financial Corporation, Zions Bank Corp, and Comerica Incorporated, have been red flagged by Moody very clearly. Thank you.
Are these the NBFCs, the shadow banks, or are they proper
These
commercial banks?
These are regional financial firms which have adequate portfolios, so it's not a small thing. Otherwise, Moody would not look at them.
The thing about this, because when there is a bank run on few banks, then it is a public psychology.
Yes.
Even the good banks, they are affected in terms of bank run. And then bad bank runs makes such banks, even the healthy banks, unhealthy. That's what it happens basically.
No, you see, the problem is KPMG gives a clean chit to SVB 15 days before it collapses. So I'm not even sure now how the auditors are working,
Absolutely.
Well, many of us, sir, as you remember, have always doubted the rating agencies, their intentions and their models. That is true. But the Fed Reserve came with I can't call it as an excuse or a genuine reason, saying that they have a certain threshold, and below that they normally don't regulate very seriously. Above that they do. And that's what they said, that the SVB came below that threshold. And now what Moody is talking about, the 5 probably are also below that threshold. Is that attitude the right thing? That below the threshold and above the threshold, different regulatory rigor? That is a different thing. But I was just trying to understand what Moody is talking about. But as far as I am concerned, sir, and please, as a chairman of the session and with your vast experience, clarify, I'm of the belief that many of these rating agencies and these Moody's and JP Morgans, Goldman Sachs, they have enough skeletons in their cupboards and really can't be the Pope for the financial world.
Yeah. I mean,
Chairman sir, I have a question for Mr. Subrahmanyam, if you permit.
Yeah, how much time we have, Charan, now? 9:36.
Sir, because I know Professor Subrahmanyam has a deadline, but I would say if he permits another 10 minutes maximum.
Okay. Okay.
Yeah.
And sir, Mr. Chairman, Vijay Kumar Sarabu also seems to have a question. So you can
Okay.
slot him at your convenience.
It's okay. You can ask the question after he has
Okay.
answered this question.
Okay, the question is that I mean, as a fallout of the SVB crisis, the deposit insurance was extended, to all the deposits, as we know.
Yes.
So, which has created a huge moral hazard, as we all know. So, do you think it would be possible for the Fed to go back on this in any future crisis? And if not, what I will call increasing wokeism among the government and the banks, central banks, what does it hold for the financial system and the overall setup that we have?
Yeah. So I think that obviously lesson learned, right? But in my view, the problem runs deeper. That I think that there's first of all, to be honest, regulators aren't as long-range thinkers as RBI. I have not experienced that. In other words, they think in the present. Abhi kya problem hai, let's solve it. I think there has to be a visit to the drawing board. There has to be a notion that, yes, we are regulating the sector. We're not just facilitating the sector. Financial sector is complicated. Many people's livelihood depends on it. Cost of capital depends on it. And real investment, corporate investment, and ideas depend on it. Entrepreneurs depend on it. So it's regulate has to be done seriously, systematically, and bottom up, not top down. We don't have to just regulate the big ones and let the little one go under the radar. I think that we have to do a full revamp and manage it from the bottom up, going from the smallest to the largest, like along the lines of the threshold, right? The threshold has to be revisited. With regard to deposit insurance, I think that the general tendency is like, let's protect the small consumer and let the bigger ones, the angel investors and corporations and so on, they know what they're doing with their money. If they will invest 4 times above the limit, then that's their problem. Let's protect the little consumers. But the big ones also seem to want to be protected because they're not seeing what the bank is actually doing. Right? They're not seeing the mismatches and the speculation and so on and so forth, the crypto problem. So my view on this is that the regulation has to be systematic, and the deposit insurance has to compass not just the little people, but also the corporate houses, because I think that the future of the economy depends on everyone, not just the consumer. To protect everyone and have a bottom-up approach is what the need of the hour is. That's it. Thank you.
But I have a point to make here. I don't know who will be able to answer that. That deposit insurance, as far as I know in India, it is the banks don't choice. They don't have choice. If they have certain amount of deposits, then I think they have to pay premium, deposit insurance premium. They can't decide otherwise. If this is left to the banks, then everybody might like to just short circuit and go around that. What do you say, Anil Sharma?
So deposit insurance is an issue in India for the simple reason that most of the banking sector, as you know, is primarily denominated in public sector banks. So there is no likelihood of their failure or depositors losing their money. Even in private sector banks, banks are too big to fail. They are systemically important. So we can't afford failure of any bank. So to that extent, there is an inherent deposit insurance, even though the DICGC says that deposits only up to a particular limit are insured. The rule says that only up to a particular limit are there. The second aspect, and of course, they have no choice. Up to a particular level, they have to pay the deposit, the insurance premium, irrespective whether which bank you are. But the problem which has been there is that the banks, the type of banks where the deposit insurance is required to be invoked, and I mean, they are not paying as much insurance as the other banks, which may never require deposit insurance. So that's an issue, that inequity in the system where the small banks, the community-based banks, the urban cooperative banks, and the small banks which actually fail, they require insurance, but they hardly pay much of insurance cover, as you will know.
That can be addressed by regulatory enforcement.
It would be difficult because otherwise you exempt the banks who have no chance of failure. Like, do we exempt public sector banks from paying deposit insurance? I mean, that's a call which is difficult to take. Why should a public sector bank be paying the deposit insurance?
Just to quickly interrupt, there is no, what's the deposit insurance limit in India? There's nothing. They're insured up to the max. Every
5
deposit.
lakhs. It's 5 lakhs. Rupees 5 lakhs.
Now it's only doubled. Okay. So, any other questions? Are we close now?
No, Mr.
Yeah.
Vijay Kumar has a question.
Vijay Kumar, yeah.
Mrs. I want a question to Mr. Subrahmanyam. That is why so weak relations in banking relations in US, and also if there is no coordination between banking relations in US, and also I want to know so much money is wasted in the form of bailout to the banks. Please answer these three questions. I think we have got
The problem. Thank you for the question. The problem is
why
the
weak
answer to the problem. Yeah, sure.
relations in US.
Sorry, what? I'm sorry, I missed that.
I have understood my questions. One,
I did. I heard the first two. I didn't hear the last sentence. Your last sentence.
Last one, so much money is wasted in the bailout, no, because of the weak regulations. So, I want to know why so many Lehman Brothers, so old bank, more than 150 years old, and also recent Silicon Bank, so many banks are collapsed. Why so weak regulations in US? I want to know. And also, I think if there is coordination between the banking regulators in US. So please.
Yes. Okay. Look, I think the biggest problem in the US is the culture that regulation should be minimal. Okay? So, and when you have a culture that regulation should be minimal and the business and the government should cooperate rather than the regulators regulate, which is their job, you will get such situations. Okay. The other, so US is reluctant to impose rules. The other thing I think is being lost these days is the ability to think far ahead and think about consequences and act on anticipation of those consequences and scenarios in the present. That people seem to live in the present. So for these reasons, and for also the reasons, remember, I told you that in my talk about I know this is politically not palatable in some arenas, but think about revolving doors, right? Revolving doors are very unique to the US. Not in many countries have such revolving doors. So like most Federal Reserve banks and chairs and governors just go back to the federal, for the financial private sector. So if they're going back to the private financial sector, the whole idea here is to, cooperate with the financial sector, then try to regulate the financial sector, right? So it's a very political reason. It's not so. The atmosphere is very different from India, where regulators take the job seriously and say our job is to regulate, protect, and there the notion is more like let's cooperate, which doesn't work very well when there's complex financial securities and complex balance sheets involved. In a nutshell, that's the answer. That's it.
Why they are not learning lessons from the previous
the reason is revolving doors continue to exist.
Why they are not
political connections continue to prevail. That's all. Sorry, Mr.
Why they are not learning lessons?
Nahi learn karenge. Sorry, they won't learn because the revolving door persists, and the nexus between politicians and regulators and bank executives persist to a much greater degree than where we are right now in India. That is true. That's why the system is failing. Sorry.
What are you saying? The regulatory capture?
Regulatory capture, precisely. I'm not saying it's a bad country to live in. I mean, look, I'm just saying that the reality is at this moment, basically that. That's all.
Okay, I think, gentlemen, then I think we must close. It's already 9:45. We exceeded time by 15 minutes. Charan, what do you say? So
yes, we should close because pretty late in the night here and professor has to start his day.
Okay, thank you so much. Thank you all so very much.
Thank you very much. Thank you so much.
I want to make 3 announcements. First is, of course, I want to thank Professor. Early morning he started and spoken to us. Thanks to him. And I also want to thank the other panelists, Mr. Dadoo and Mr. Anil, to have been with us, working late here in the evening, and to the chairman of the session, Mr. Sharma, to spare some time late in the evening and talk about this. While there are advantages of technology across the globe Right opposite at 180 degrees is Mr. Professor Subrahmanyam, but we are able to sit together and talk across the planet. I think that's the beauty of technology, but this was the only time which I thought was possible to bring us all together. I would also like to mention that today's discussion, as you have seen, has been very rich. We have had practitioners, we have had the professor, the theorists, and we have also had policymakers sit together and talk today. It'll be available on our website by tomorrow noon. You're welcome to use it as you wish. The last announcement for the day is next Friday, we are going to be discussing on income inequalities. There'll be two professors presenting the paper, which are published, and there'll be a chairman and a discussant, exactly the model like we had today. I would invite all of you. You will see the announcement. The time will be around 6 to 7:30. I would invite all of you to please come, participate, and enrich the discussion on income inequalities. With that, once again, thanks to all the participants, to the panel, and to the chairman. Good night, and see you next week.
Good night. Good night. Good night,
Thank
all of you.
Thank
Good
you.
night, all of you.
you
Thank you
very
very
much.
much.
Good night.
Thank you very much. Good night. Good night.
Bye bye.